Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, November 30th, 2022. So as we embark on the last trading day of November, with one more month left in the trading year, I wanted to do this video. This will be a quick one, I promise you that. I always say that, then I go on and on. It's more so an update to something I covered a couple of weeks ago, and I also wanted to get this out there and let you know my thoughts. You know, as of the last couple of weeks, I told you I've been personally into short-term trading mode. From my experience, the market's probably going to grind around, and that still may be the case. But I wanted to show you some developments which help support the case, at least in my opinion, to maybe start scaling back into some swing or trend short positions on the market. That is, the major stock indexes. So what we're going to look at, and what will keep the video relatively short, we're going to look at about 15 or so charts, but only one thing one thing that I want to point out on each chart, and that is a very simple but fairly effective indicator, and that is a bearish crossover on the PPO. So again, if you watched that video a few weeks ago, I pointed this out. Down here, this is your PPO. These lines here, you have the white line, which is your signal line, and then the yellow line or orange PPO line. So when the PPO line or the orange line crosses down below the signal line, the white line, you can see it better if I really zoom in like that. That's a bearish PPO crossover, and the PPO is a trend indicator, and so it's just showing you that the trend, whether it's bullish or bearish, likewise you have a bullish crossover when you cross from below, shows the trend is waning or appears to be shifting. There are times, and I'll just say this, that you want to really not read too much into bullish and bearish crossovers, particularly in sideways markets, consolidating markets. And so what I like to look at are what I call hills. I like to see big hills. This is a green hill. This is a big green hill. There's a red hill, upside down hill, if you will. These are periods of choppiness right here, where you have these small hills, little whipsaw. You're getting crossovers followed by another crossover. So I stay away from those. When you look at the big hills, that's when you have nice trends. You have a clear uptrend that's unmistakable. That's, nobody can confuse that for anything but a strong uptrend. Likewise, nobody can confuse that for anything but a clear downtrend, and you can see by the hills. So I'm just going to go over. This is the S&P 500. I've done this before. And I'll point out. Let's just focus on the market we're in now. We're in a downtrend. You can be as bullish as you want. You can say what you want about the market, but you cannot argue that the intermediate term trend, or the primary trend, at least throughout since the beginning of the year, is bearish. And that is a simple definition of a trend, a downtrend being any security making a series of lower highs and lower lows, and that's what we've been doing here. We've been stair-stepping down. So once we take out this high, that starts to bring the downtrend into question. So we're going to go off that. I've already covered the kickbacks to the 200-day moving averages, and again, remember, this is just one indicator, and it's not 100% effective. There are times you get these crossovers, and they prove to be whipsaws, okay? But with that being said, and I'll go through these charts, here we go. There was a big green hill right here, and there was we're in a bear market, so I'm going to focus just on we can look at both the bullish and bearish, or you can do that yourself. But there was a bearish crossover. So if you shorted there and you held until the next bullish crossover, you milked most of that leg down. Then if you got long on the bullish crossover down here, you got most of that leg up. You can see there was a sell signal. Wasn't a lot of meat left on the bone by the time it crossed over. I'll say that because it was a quick turn right there. Nothing, again, I don't use this indicator as a standalone buy and sell indicator. It's one of many things, and it helps support a case, but you can see if you used it alone, let's say you got long there on the bullish crossover, you might not have nailed the bottom, but you caught most of that uptrend, and you stayed long until it said get out and get short, right? All right, so you see it. There was a little whipsaw there. You got a buy signal, a whipsaw, one more low, but it wasn't, even if you took it, you still got most of this uptrend. Okay, so here we go. As of today, and the day is still young, very young. The market just opened. We're only half an hour into trading, so remember that this is a daily time frame I'm on right now. So if we reverse today and have a nice big green day, well, you're going to not have that bearish crossover. But as of now, if you look closely, you have a bearish crossover on the PPO. And the other thing, and I've said this before, you can often extrapolate or just visually look, and when you see the PPO starting to roll over, that's the PPO here, the histogram bars, which are just a visual differentiation, but a visual of the differential or the distance between the two lines. And so when the lines start, when the PPO line turns down, that's where the hills start going down. The histogram starts moving down. And you can almost see right there. Remember, I pointed it out back here a few weeks back, but we never got the crossover. So there was no sell signal. The lines kissed and bounced. But now, again, it's crossed over and it looks imminent to me. Again, once in a blue moon, you'll get what it looks like a surefire crossover. And also, if you just take a look at the hills, remember, this is a bear market, and this is swing trading. This is what we do. This is the crux of what this site is all about, swing trading. And these are the trends. And so we try to capture, or at least I do, when swing trading. I'll wear different hats. Sometimes I'm in day trading mode. Sometimes I'm investing long-term trend. But this is a great swing trading time frame, and it's a great vehicle. So that's it. So I'm just going to go through the rest of these. I don't want to oversell it. I'm just trying to explain what it is and show you pretty much how effective it's been, which I just did. So there's SPY, QQQ. I'll just go over here. Right now, we do have a red little blip on the histogram, meaning the PPO has made a bearish crossover. We'll see how the day ends, of course. And even if we end up with a green, even if we don't get the red or the crossover today, a lot of times, or sometimes I should say, it takes a couple days, and sometimes you get, looks like, for example, on this bullish crossover, you had it and made the bullish cross, you got a little whipsaw, but it ended up sticking. There was a bottom there, just one little flush out move that came at the end. So you could have something similar, maybe one more pop up, and then get the crossover. But I always say this. I say a lot of things over and over because that's what this is all about. There are no guarantees in trading. It's just like gamblers that go to Vegas, and the professional gamblers, they play the games with put the odds in their favor, and whether you're playing a game with random odds, like you're pulling the one-armed bandit, which I think has the best odds and one of the best in the casino, or you're playing a game like poker or craps, or even blackjack. If you want to put the odds in your favor. Okay, and that's what trading's all about. There are no guarantees, but it's also, there's no absolute certainties, but probabilities. So I stay away from trades that I don't think have a good RR or good risk reward profile, or those that I don't think will play out. And so the probability is pretty good right now. When you get a bearish crossover, that's going to signal the next trend. So there it is. You have it on QQQ. QQQ had a little whipsaw, but I just showed you S&P 500. The last time we had a crossover, other than this whipsaw here, I'm going to say, and that's a great example that nothing's perfect. There was a whipsaw, but you had a nice big green hill here, right? And there was your crossover, and that would have got you, short, or at least maybe milked some of that, or a good part of that. There was a nice one back there too early in the year on that big green hill. Small caps, IWM. There it is. We've already crossed. We're 3 days into a crossover. So that's a solid. Look at that. Very few, if any, whipsaws, at least going back to April. There's a couple there, right? And there's also where I said you want to stay away from it. See that grind right there? That's exactly when you don't want to put too much of an emphasis in there. You want to see these distinct uptrends, and then the hill rolls over. Boom, there's your crossover. Oh, I didn't draw that evenly. You can see where I'm going. There was a crossover there, and there's the big drop that came after, and there was a bullish trend there. I can do this as well, just box in these hills, and you can see the trend within. So that's it. So we've got a crossovers, and respect this. If it is a whipsaw, if these are whipsaws, and this starts going green, and there's an example where it looked like you were going to get a bounce, right? But you didn't. You never crossed over, and the lines bounced. And so we'll respect that. If a week from now, 2 weeks from now, These bearish crossovers are those that are about to cross. I'm just going to cover the 11 sectors of the S&P 500 and then we'll wrap it up. But if you get whipsaws, you have to respect that. And as I often say, very important takeaway, fewer things in trading are more bullish than a false sell signal. If you do get that, then respect it. We may go up and hit the higher end of my bounce targets. I have all the levels turned off here, or I did just to make, because I was trying to focus on the PPO. But remember, on the S&P 500, we only hit on a couple instances recently the bottom right here. These two. This is my most likely bounce target range, and we already hit the bottom of it here and here. And again, and anything's possible. But as of now, like I said, here's another takeaway, another thought that goes into my head. Again, we're in a bear market. I believe we're in a bear market that's more to come. So I would rather get in early, start scaling in now, which is what I'm doing. I gave you the short-term trade. Remember yesterday I did the video, I gave you a long here on the break of this level. We were right about here. We had just overshot this support level, which I figured would be a momentum fueled overshoot, and it was. Gave you a target of this downtrend line right there, which it was, hit perfectly. And so if you had a sell limit order, you got out, you were profitable in that trade. And then, as I said, we had a rejection here. We put in a little divergent high. So I've been in short-term swing trade mode. As of now, this is my first lot. And I'll decide, like I said, you can have a tight stop a little bit above that reaction high. There's a nice resistance level as well. You could have a stop here. Now, where your stop is depends on what you're targeting. If you want to stay in short-term trading mode, keep that stop real tight. In other words, let me zoom back in. So if you shorted here on this downtrend line, which we're at right now, we're still there, still plenty of time. You can I'd put a relatively tight stop, and you maybe target a marginal new low, might be a divergent low. Keep trading this 10-minute chart, look for divergence, or put on a swing trade. Then you really go back out to the daily chart, and then you decide, okay, if I'm swinging, or even the weekly chart, well, I'm swinging down to the next target. My next target here in the bear market is all the way down about 235. So that would be a swing target right there for you. And if you're going for 235, well, that's a drop of another 17 or so percent. So you could easily allow, let's say, 5-6% stop loss, still have a nice, very attractive risk reward profile, even maybe 7% or so. Okay, and onto the sectors of the S&P 500. And as I do this, just keep in mind that these are in order of weighting in the indexes. Technology is by far the largest sector, largest weighted sector in both the S&P 500 as well as the Nasdaq 100. And there's your bearish PPO crossover. Okay, so again, whipsaws once in a blue moon. There was ever so slight crossover there, and the lines kissed. But there was the last clean bearish crossover, and it would have been really nice to have put on swing shorts there and stayed short until you had the bullish crossover here, or call that a whipsaw, and then that was the bottom. Either way, these are the trends. These are the trends you want to trade. We had a bearish crossover there. Again, that one came late because this was a very sudden and swift drop. That's unusual to see such a fast reversal. Usually it's more of a slow roll. And there was your other one back in April right there. So again, pretty good, pretty reliable trend indicator. And just box it in. See, oops, I missed that. And we're red there and got all of that. We were green there, and most of that trend was bullish. We were green here. Most of that trend was bullish. You got it. All right, moving on. Healthcare XLV. Got it right there, another one. So what I'm doing here is, again, I'm doing probability. I'm going over the 11 sectors I'm showing you so far. The largest has a bearish PPO crossover, the second largest, XLV, as of today. The line's hard to see, but it's right there. It's a little red blip. And so again, how we close today will either firm up or maybe It doesn't negate these sell signals. It may just delay them if we don't get the crossover yet. But to me, based on the scope of the hill and everything else and all the other things going on and the rejection at the 200 days recently on the S&P 500, it's a pretty good chance. So XLF, financials, 3 days into a bearish crossover. XLC, not there yet, communication sector, but close. XLY, consumer discretionary, not there yet, but close. You can see, last time we had a crossover was right here, and we had a little whipsaw here. I'm going to call that one a whipsaw, but that captured that downtrend there, that all those red histogram bars. And this one's been a weak bounce. It's been green. That's why you had a whipsaw, because it's more of a consolidation. We really haven't gone anywhere. So there was a nice uptrend, and there was a nice downtrend that the histogram captured. Okay, a few more. XLI is the industrial sector. 1, 2, 3 days into a bearish crossover. Last time we had one was right here. You would have shorted at this candle here if you were just going mechanically off that. And even if I won't even play the game to the very low, we'll play the game to when you had a bullish crossover. So you would have covered there, and you still would have made 9.5%. But of course, we use this in conjunction with everything else. There would have been other buy signals there. It was a trend line break. Oh, there it is. My lines just went on when I tried to add a trend line. There was a little wedge and a breakout and all that stuff, and the divergences were in place, so we would have been covering shorts or lowering stops at that point. And had I been in XLI only, we were in the market at that time. Okay, a few more. XLP is consumer staples. Not yet, but you can see the lines. It looks like a crossover is imminent or likely. And XLE, energy sector. This one just hasn't gotten the memo. I'm still maintaining, this short position personally, and on the site, still think it's a good one. We've just, we broke down over here. Let me grab my drawing tool. We broke down right here. There was a breakdown below the trend line. We back tested it, put in a divergent high at that point, even a bigger divergent high here. And it's energy sector just hasn't gotten the memo, but it stopped going up. See, that's what trend indicators are all about. This is an uptrend. You had strong momentum. It's not really going down, but it stopped going up, and that's why the momentum indicators have rolled over. And well, take it for what it's worth. Either way, we've got a red histogram, and if I turn off all the lines here, and again, we just look at the last time we had a red histogram, that was the price action in there. Time before that was right here. Okay, and so that's what we're looking to see. Sometimes you'll cross over, and it's just you get I always say that there's one or two ways or a combination thereof in which anything in any index or a stock or any security can correct. It can have a correction in price, which is what most people think of a correction as, or it can correct in time. And by just consolidating those gains, digesting the gains, working off the overbought conditions before the next leg up. But sometimes it starts out like this. I'll give you an example. IWM, among many, IWM in many sectors in the indexes, when you turn off all the lines, they had this consolidation here for a while after a strong uptrend. This was the end of the bull market. And then after that consolidation, the trend began lower. All right, a few more to go. That was XLE. Here's XLU, the utilities. I'm going to turn off that. You can see there's other things here to watch, trend lines. Again, it would be a long video if I showed you all the reasons, and I will continue to update. I want to see support levels like this, for example, break. Because again, a PPO crossover is pretty good, pretty reliable, but not the be all end all. So here it is. You have almost a crossover. You can see the lines rolling over and the histogram moving down. So we'll watch this. But when we get down to the bottom here, which I'm at, these don't move the needle. They're about 3, 4, 5% weighting, not even in the S&P 500, and that's utility REITs, which again is about to cross over. But the takeaway here is, remember how well, you don't have to remember, I'll tell you. The S&P 500 has led the advance off the lows. It's outperformed the Nasdaq 100, which tells me one of two things. The leaders are still lagging. We're in a bear market until the leaders start leading. Apple, Microsoft, Amazon. That's why the Nasdaq 100 has lagged. So number one, that's indicative of a bear market. But number two, we've seen broad-based participation. So the S&P 500 went up because you had a lot of these other sectors, including financials, that have been strong, and financials aren't in the Nasdaq 100. It has very little, if any, weighting of any financial stocks. So where I'm going, it's been a very broad-based rally. That's what's brought the market up. But now I'm making the case that not just one or two, but nearly all 11 sectors. Most have already made a bearish PPO crossover or appear poised to. And I may be wasting my breath here in a 20-minute video if these prove to be whipsaws. But I did enough of that kind of disclaimer kind of stuff that, hey, don't get married to it. I'm like, Randy said, look at this, look at that. Oh, I'm going to catch that. Yeah, there's a good chance. I think that'll happen, and that's why I think it's a good time to start scaling the shorts for the next leg down, because would have worked right here, would have worked right here, would have worked even right here a little bit. Would have worked right here. This is when you want to be short, and this is when you want to be long, when these histograms are green or red. And so we're rolling over it, guys. And last but not least is XLB, Basic Materials. And that one gave us a bearish crossover yesterday with a confirming more downside today to make that histogram even more red. In other words, the lines are clearly crossed over now. And you can even look at other sectors. I already covered XLK, which will include the semis. It's the broader base technology sector. So that is, again, one of the sectors in one of the 11 in the S&P 500. But the leader, the semis kind of lead the tech sector. When the semis are strong, it's usually even a leading indicator of the overall tech sector when they start to rally before tech rallies, and vice versa when they roll over. And as you can see here, we rolled over yesterday. Was the actual? There's a little tiny blip, little red histogram bar, and there's a follow through today. And I did a video on the semis recently, making the case that the bear market rally is likely over. And that ran into downtrend line resistance. So the takeaway is, despite my recent comments, this isn't a hard all-in, swing short, but it is me now saying, what, even though we've got the Fed coming up and the markets are likely to grind around and seasonality is bullish and all that other stuff because 401k monies come in at the end of the year, and it may be a grind around. Well, that's what swing trading's all about, is put your positions in. Even if the market's going to grind around, I think it's going to, most likely, I think the odds are it's going to grind lower. I think there's a good chance we'll be lower in the month of December, even if it's kind of erratic. And so for swing trading, I just tend to use wider stops, give it a little more room, and some of the levels. For example, the 200 days downtrend lines, those are some of the things I'll be watching. Do we get whipsaws across the board on not just one sector but multiple sectors? Everything like that would then convince me, or enough of that would convince me to, hey, either stop scaling in to short positions or start scaling out of, or even hard stop out of the existing short positions. So hopefully that helps, and I'm going to keep to my word and stop the video here at the 23-minute mark. This has been Randy Finney with Right Side of the Chart. Have a great day.